All right, well, let's start with some general introduction for those that are on here and people that hop in. They're not going to miss too much on the early front end, but appreciate you guys all making the time today. My name is Corey Brandt. I work with Disaster Recovery Services in our business development role. Appreciate you guys joining us to learn a little bit more about the value of a preseason, as we like to call it. We have a program called Planning for Disaster, or P4D, and it's some various service offerings that we like to teach and educate on as much as possible, and more blue sky operations, before something unfortunate occurs. And this component today will dive in more to your commercial property insurance, kind of like a high level policy review and some tips to take into consideration when reviewing those, as well as some other kind of proactive steps you can take, and from a risk management perspective. But I wanted to introduce Jason Trahan, as well as Shelly Vineyard, who's on this call. It's going to be led by Jason Trahan. Shelly Vineyard on our team will be on this call too. She's our procurement lead, and available for any questions later on in the presentation, as you'll see. But Shelly, if you want to do a quick introduction, we'll go to you, and then Jason, and then we can kind of roll into things. And one more thing before that. I'll be managing kind of the chat section. So we don't have a Q&A, but we have the chat feature. So it's encouraged that as questions arise throughout the presentation, please drop them into the chat. I'll make sure to take breaks and pause Jason or Shelly, whomever it is at the time, to bring up relevant questions. We want to make sure that we're answering as many questions that are top of mind for y'all to make this as relevant as possible. So please use the chat function. And Shelly, I'll let you go from here and then pass it on to Jason.
All right. Thank you, Corey. Good afternoon, everyone. Really great to have you all join us. I, again, am Shelly Vineyard. I am a consultant with Disaster Recovery Services, and I specialize in federal procurement and contracting. So I head up our public entity procurement group. And while we're going to be focusing on commercial insurance today, Jason's going to have a lot of great information and strategy he's going to share. There may be some things that come to mind as you think through storm season for our public entities. Typically, you're going to have commercial insurance and then maybe some reliance on FEMA. And so if some things come to mind about procurement, contracting, et cetera, I'm here to help answer any questions that might come up along those lines. And Jason, I'll turn it over to you.
Thank you very much, Shelly. As Corey mentioned, my name is Jason Trahan. I'm the commercial insurance claims practice leader for Disaster Recovery Services. What that means is, I primarily for the last 25, 26 years have assisted policyholders to prepare, manage, and settle commercial insurance claims. But in the public entity space, commercial insurance is just a component of that. And as Shelly touched on, we'll also talk about the FEMA implications in this kind of overall preseason review of commercial insurance, as well as kind of planning for disasters here, as Corey mentioned. So we refer to it as preseason. Preseason may be different, for each of you on this call. Depends on where you're located in the country. You may have disasters that are wildfires, flooding, hail, tornadoes, or you could be located in a windstorm zone. So the preseason for you could look very different. And actually, if you're in a windstorm zone, your preseason is quickly coming to a close here with the activity that we've already got in the Atlantic, and storms kind of making their way towards the Gulf. So what we're going to do is cover some more simple review ideas to prepare for things. A lot of times, especially in commercial insurance, you hear business continuity planning and a very complicated, maybe organizational risk assessment. And what we found is a lot of times that process is paralyzing for people in risk management or other areas, because the task just seems so daunting. So what we're trying to do here is talk about kind of the 80-20 rule, if you will.
Calling Jorge Gonzalez, mobile.
What are some simple things that you can do and that you typically do in the recurrence of your normal renewal process that we can incorporate in to help you prepare for things? So we're going to go over a review of your assessment commercial property insurance coverage and some proactive steps that we can take that can help restore your operations quickly after loss events. But the key here is to keep it simple. And Corey mentioned P for D. So this is going to follow in a structure of review, identify, implement, and monitor. And so that's going to be the format that we'll talk about today. And under each of those, there's a few bullet point steps that we're going to touch on in more detail here. So we're obviously going to review commercial property coverages. We're going to talk about statement of values. We're going to talk about standby contracts and how those have become definitely more important in a hard property market. From that, we're going to identify potential risks or areas of improvement, and then talk about steps that we could take to implement those improvements. And then finally, making sure that you have this as an annual monitor or review process of the steps that we'll talk about. So that's going to be the flow of things today. And appreciate everybody joining today. I know this webinar was blocked for an hour and a half. We will not take that long. We should cover all the content here, probably inside of about 45 minutes or so, and then leave some time for question and answer. So with that, let's get into the review portion of this. This is where you step back and look at the organizational background and loss history of your organization. Some of you on this phone call may have been at your organizations for years,
Okay.
if not,
Have a great trip.
decade or
Thank you.
longer.
Bye. Bye.
If everybody wouldn't mind maybe staying on mute, I don't know if Corey had mentioned, everybody's lines are open here so that we can have questions and stuff, but we do want to minimize background noise. So looking at the organizational background and loss history of the organization. So if you're new, kind of taking a step back and saying, okay, what are the types of losses that our organization has had in the past? How does that line up with our coverages, sublimits, what's allowed? Are we buying commercial insurance coverage that matches up with what our experiences are? Some of the stuff we'll talk about here sounds kind of like Captain Obvious, but I've done losses for communications company who actually had an exclusion in their policy for data and communication lines. And that's the core of their business. And the broker didn't catch it, and no one caught it when they went to put it in there. So reviewing, what your loss history is and how your coverages align with that sounds simple, but a lot of people don't do it. And then let's also look at any existing business continuity plans that you may have. Things that may have been done years ago, things that may have been done by your predecessor. Let's not reinvent the wheel if we don't have to here. And this, helps you in doing this process. You'll probably gather together what risk management plans and resources you have available to you. And then we're going to get into more of the details of the policy itself. Let's look through all of your policy named locations. Let's start looking through the coverage that you have and thinking through, as we review that, what the risk appetite of the organization will be. And we're going to do that through this policy review checklist, which again, as I said before, some of these items seem pretty simple and straightforward, but we're going to talk through more detail behind each of these bullets, but some of them would surprise you. Can't tell you how many claims that I've gone to work with people over the last, 2.5 decades where a loss happens and I say, okay, well, can we get a copy of the current policy and take a look at it? Well, we just went through a 6/1 or a 7/1 renewal and the insurance carrier hasn't,
I've got
updated policy.
I'm monitoring a meeting, so.
Let's see if I can mute that. So anyway, so I talked with them and they've just gone through a policy renewal and the carrier hasn't issued the updated policy, or they haven't gotten it from the broker. So, here we are looking at last year's policy, but yet some terms may have changed, limits may have changed, some wording, everything may not be as it was last year. So as you're going through renewal, making sure you get these complete documents as soon as they're available, and definitely before you go into whatever your disaster season is, as we talked about, whether it's wind, flood, wildfires, whatever, making sure that you have all that documentation before you. And that means getting copies of all applicable policies. So commercial property insurance is obviously key, but then NFIP policies, making sure you have those for all the locations that you need to have those through. And whether you're a private entity or a public entity, you may have stock throughput, which may give you some preferential wording as to the valuation and or deductible access for contents or equipment and stuff that you have in different facilities or warehouses. Making sure you have all that stuff pulled together so that we can review that, and making sure that the policy is complete. And that means, not just the binding agreement, but, your full declaration page with all of your endorsements. This is an area that bites people too. We've got a body of a policy, but they don't realize that there were 3 or 4 endorsements that were maybe issued late when binding was done. And those endorsements at the top of each of them say this endorsement changes the coverage in this policy. So making sure we have all those before us so that we can start to review applicable, limits of liability there. And so, Shelley, if you would mind maybe kind of checking the mute buttons across. I'm still getting some background noise.
It's a decent program.
So maintaining a copy of current schedule of values and insured values. We're going to get into this a little bit more detailed, but this is something that schedule of values is a garbage in, garbage out type situation. So if you're just taking what was there last year and rolling it forward for renewal because everybody's pressed and we're trying to meet renewal deadlines, a lot of times things can get missed. And so we're going to talk a little bit more about that later on the schedule of values and insured values. Determining if those schedule of values are your limits. A lot of times people have a blanket limit, for a given peril in the policy. But a lot of times the schedule of value limits you as to what you can recover for each one of those locations. Okay. And so you need to evaluate that. And we're also going to talk about the valuation of the statement of values a little bit later too, and the importance of that. Because if you are limited to this, your schedule of values for that location, there may be a margin clause in there that allows you maybe 10% over that value, maybe even 20% over that value. But don't go into this thinking, oh, I've got a $5 million sublimit or a $50 million sublimit for apparel. If when it actually happens to a location, you're limited to the declared value for that location for the physical damage and maybe contents that are lost there. Another here is confirming and understanding deductibles. Deductibles are the access to your policy. So whatever you have as sublimits for the different coverages, deductibles are how you get into it. And a lot of people don't understand necessarily how those apply. You'll hear a windstorm and someone will say, oh, I've got a 3% deductible, or I've got a 5% windstorm deductible. Okay, 3 or 5% of what? Is it of the individual building? Is it of the unit of insurance? Is it of the total insured value? And those can change pretty drastically. So to give an example here, if you've got a 3% windstorm deductible for total insured value, and you've got building and contents reported. Now, there's a lot of public entities on this call, so you maybe don't have that business interruption column, but if you're a commercial enterprise, you may have that as well too. And all those go into your total insured value. And what that means is if a storm blows in and I've just got damage, say, to the building, and the building is relatively inexpensive, maybe it's a metal building that's not that expensive, doesn't hold that high of a value. But the contents in it are very expensive. They're very valuable. And maybe there's even a business interruption component too. Well, if it's 3% of total insured values, I've got to take the sum of all 3 of those categories in order to be able to access the policy, to be able to just recover for damage against the building. But if it's stated 3% per unit of insurance, then that statement of value that's quoted there, I get to just claim the percentage against the area that I'm claiming against. So let's say it's flood damage that, again, in our metal building doesn't do much damage to the metal building, but damages my contents. Well, if it's per unit of insurance and I only need 3% times the contents to recover against damage to those, and I don't have to drag the building in with it and boost that deductible and increase the hurdle to get access to my policy. So some of that wording is very specific. And so just make sure you understand how that wording of the deductible is. I've also got average daily value deductibles here, which is really more of a business interruption. But then there could also be waiting periods for extra expenses and stuff too. And understand whether those waiting periods are just a qualifying period, maybe 24 hours, and then you go back and you start measuring at hour 1, or if those waiting periods are actually a limit of liability and you don't access your policy until the hour after that waiting period's expired. Again, it's all in the wording, but it can definitely differ how you access your policy and what your recovery is. And making sure you and the hierarchy above you understand that, so you know how your policy works for you, is critical to managing those expectations within your organization. Next is reading and understanding those endorsements and how they apply. If we've got something that excludes flood, if we've got an endorsement that excludes, mold or virus, as we all saw through COVID and everything like that, a lot of people had exclusions for viral and infectious disease. And so that, definitely hampered coverage that people had. And they thought, oh, I've got an all risk policy, but there's a specific exclusion in there for certain items, and making sure aware of those, again, so you can manage expectations internally. So reviewing those policy exclusions is actually the next one. I kind of jumped into that. Next is read and understand definitions. So on the statement of values, you might have a series of addresses listed, and each one is a different location. How does a policy define location? What if you have 5 buildings at a given address? When it comes back to our discussion on deductibles, do I have to take 5% of the total insured value or of all the buildings at that given address if I only have, say, 1 building actually damaged? The wording of the policy could necessitate that we take the full percentage value of that address that's listed there, because that address is considered the location, percentage deductible by location. So in that case, sometimes it's maybe taking a more granular look at your statement of values. And yes, you may have 5 rows on there that are the same address, but it's building A, B, C, D, E, to try to get the different valuations and the different buildings there to allow you to access that. Or having the deductible wording be, by structure or by building, as well as per unit of insurance of what's needed there. So these are just some areas to assess how are you reporting your assets to commercial insurance? And then how are you able to access that? How does that deductible structure work? And how does the wording and the definitions access for your schedule of values, for your locations, and then also for your different units of insurance? And at least everybody on this call is probably going to have building and contents listed for those statement of values. And then also, finally here, I've got identify any time constraints. And a lot of times this happens when you have a large loss, say a flood or a hurricane, it drags on for a long time. Commercial claims don't settle like, individual personal lines. And that's a lot of times people's own experience. Car claims or homeowners claims settle in a matter of days or weeks. These could take months, if not years, to resolve, depending on the extent of damage and the period of restoration. So make sure you know your rights under the policy if there's any disputes there of what you need to file suit. In most policies, it's going to be a 12-month period. If you reside in the state of Louisiana, that's de facto by state law 2 years, regardless of what the policy says. But just make sure that you know that, because if you are bumping up on that 12 months and you're still working in good faith to get resolution with the insurance carrier, they will almost always issue you a tolling agreement, which basically allows you to toll your rights under the policy for a defined period. So if you need another 90 days or 6 months to get things wrapped up, the insurance carrier will definitely issue that to you. But make sure you don't miss that date and then you pass, because then if you have a definite dispute with the company or the insurance carrier, you have lost your right to file for litigation under that if you don't maintain your rights under any kind of tolling agreement or settle the claim within the constraints of the policy. All right. So that's a lot of detail on that one in the checklist, but it is key for our review process of reviewing that, because then that's going to get us into our next stage here, which is identify. So now we've reviewed, we understand what the policy says. We understand what our statement of values currently shows. We've seen our deductibles. So what are the risks that we think we have based on our location and our loss history, and how maybe do we need to change that? So we reviewed and we noticed that, hey, our flood sublimit is lower than what we need. We've had some flood losses in the past, or we've got more locations that are in a flood zone or a windstorm or whatnot. And just making sure that based on your risk appetite for your organization, that you're getting coverage as to what you need. And are there key areas of improvement? We just talked through a few of them. Or there's some tweaks that we can make to the wording on the deductible. Highly advise getting that per unit of insurance in there. And then also making sure you know the definition of location, how those deductibles are going to apply. And then also too, on your statement of values, are you limited within those statement of values to recovery, for each of the locations and those reported values, or is it blanket coverage for a given peril? And making adjustments based on what you think you might need. So the completeness of the commercial property documentation in the SOV, again, this sounds like Captain Obvious, but if it's been rolled from year to year, things can get missed. And it's a sad conversation when I'm called by a client and they have a loss event. And the first thing we do is look through and we can't find the location on the statement of values because it was a location that was recently purchased or purchased last year and they forgot to update the SOV. Or it was a location maybe that was bought even beyond the year, but they came into the program last year, 18 months ago, and just rolled things forward, based on what the documentation their predecessor had. And then all of a sudden, they're now limited to a sublimit for an unlisted location. When all this could have been, solved if we would have just reviewed it for completeness. And then also, too, you have buildings that have been sold or decommissioned. There's no sense in paying premium on those within your statement of values where things can kind of get lost. And there may be a handful of locations in there that you can drop because you no longer operate or own those locations. So this is where it's good to probably pull a fixed asset register from your organization. The reason I state that is because that's something that's going to feed into the balance sheet that's typically going to be audited by a third party. So it gives some validation that that fixed asset register is accurate. And then let's do a VLOOKUP of that fixed asset register against your statement of values to make sure that we at least have all the locations issued. We'll talk a little bit later about the valuations on those, but right now we're just looking for completeness to make sure that everything's listed. And then also obtain and maintain requirements. As you're looking to put in your SOV and what values that you're going to insure against, have you accessed FEMA before? And if you have, you can have obtain and maintain requirements that you need to buy commercial insurance up to a certain level in order to be able to access FEMA in the event of a subsequent disaster event. So for example, if you had $50 million worth of commercial property coverage before, and after a hurricane, your organization incurred a $75 million loss, and you turn to FEMA for that additional $25 million. Well, FEMA is going to want you to have $75 million worth of coverage going forward before they pay for another hurricane loss for your organization. And if you don't have coverage up to that level, you will see redactions of your FEMA project worksheets for your lack of obtain and maintain requirements there. The next here is disaster recovery team resources. So let's make sure that before a loss event occurs, that you've got those folks that you're going to need to work with in the event of a loss sort of lined up. And you know who they are and they know who you are. And internally, that can be your risk management, your facilities folks, within accounting, some sort of operational controller that's going to help you set up loss accounts to be able to capture costs. But then also, considered kind of part of your internal or maybe even external team, you've got your broker. And within your insurance broker, you probably have a commercial claims advocate. And interfacing with them, making sure they're familiar with your business, they're familiar with your coverages, because that person is going to help you interpret and argue coverage to the insurance carrier in the event of a loss event. So making sure that you're familiar with that team is critical. Now, along with the external team, some things that you could influence is having a designated adjuster within your program. If you've got an adjuster that you have liked working with in the past on losses, or that you have peers that have recommended, well, you can absolutely get them written into your program so that it's not potluck after a flood or a hurricane or a tornado as to what adjuster you get. You have a named adjuster. So not just a named firm, but a specific person, a named actual person adjuster that you want to work with, because you take any large independent adjusting firm, there's really good adjusters and there's some really not so good adjusters in there. And so let's not leave that to chance, and let's make sure that you've got someone named in your policy for that. And then also you may want to think through what your team is going to be for your disaster recovery. And we're going to talk through that a little bit more, whether that's standby agreements for remediation firms or commercial claims preparation or FEMA claims preparation, whatever services you think you're going to need to recover after a loss event, try to work those out in advance. We're going to talk through those a little bit more as we get into the next phases of implement. But within all these services that you're going to have to buy, this gets into Shelley Vineyard's specialty here of the procurement side. So let's say you've got commercial insurance, you're buying resources just as your normal course for your organization, but the insurance runs out based on the disaster that's occurred, and you've got to turn to FEMA. Well, you better make sure that those purchases that you're making are in accordance with 2 CFR 200, which is your federal procurement procedures, because otherwise you could be in trouble as you go to turn to FEMA. And so as Shelley had pointed out in slides for past presentations, 81% of recovery funding is going to be used to make purchases. So make sure that purchasing is in alignment. And another great slide that Shelley likes to share is this one here, because procurement missteps are the #1 clawback for FEMA. And those can happen in a variety of areas. After a loss event, it's a panic, it's chaos. You want to get vendors in to help restore your assets, restore the services that you're providing to your customers or your constituency, and you want to get that done as quickly as possible. Well, FEMA allows for that within the emergency situation. You can have emergency and exigent situations that allow you to bring in contractors, but the dust is going to settle on that. And you need to make sure that as you're going forward for your full recovery, that you're meeting those requirements. And the first one here is full and open competition. And you can't just dub, hey, that's my guy, that's who I want to use. Federal procurement doesn't necessarily work that way. If you're jumping over here to #4, if you're continuing work under a sole source contract, after that urgent period has stopped, you're going to need to meet all the requirements that Shelley's got listed here is some, grants mistakes. And so not #7 here, not including required contract clauses. Those could be areas of stumbling, as well as using contractors that are suspended or debarred from federal procurement is a huge misstep there. But then even if you do all the right things, #10 here, and you don't document what you did, that could wind up getting you in a pickle down the road. And so all these sort of feed into this slide here, which is a bit shocking, which is some different, examples of clawback that's occurred to organizations. So here we've got an example of a public school district who had lack of federal contract provisions and no affirmative steps taken for socioeconomic contracting. It resulted in a $187 million clawback. That's huge. Especially when you look into this, and with each of these examples, these are monies that the organization have received from FEMA. They thought were theirs. And then later in an audit or an OIG audit, it's discovered that they did not meet these requirements and clawback has occurred. So you can see here under a HUD program, inadequate procurement supporting documentation, again, just not having the right documentation. And restricting competitions, not having that full and open competition, $10 million clawback. Here's another 5 state grantees, that inadequate procurement supporting documentation, lack of internal controls, and then they didn't do the suspension and debarment checks, $9.2 million clawback. And another here, public school system with incorrect procurement and absent documentation, a $12.2 million clawback. Now, we have clients that we've come in to work with that didn't have us helping them with FEMA on the front end. And the problem is a lot of people that know they could maybe obtain this documentation, move on. They leave the organization, they go other places. So we're working with a poor risk manager who's facing these audits now by FEMA and can't find the documentation. The person that handled it is long gone. And it's resulting in millions of dollars going back to FEMA simply because they can't prove what they did 5, 7, 8 years ago. So FEMA's got a very long tail on it. And these audits could happen years down the road, and there could be a total different group of players in this. So making sure those procurement processes are lined up in advance under 2 CFR 200 is really key. That way, whether you're purchasing under your commercial insurance for your recovery, you're good. But if you do get in a situation where you need to turn to FEMA, and it's not only excess, but it could be those 3 to 5% deductibles that we just talked about. You could be pursuing those recoveries from FEMA, and you still have to meet all these requirements to do so. So now we get into implement. So we talked about we've reviewed all the documentation, we've determined where we need to make some improvements, and now it's time to execute on those improvements. And the first, as we talked about with some of the external team, is standby contracts for critical services. Now, you can't necessarily contract with every possible thing that you would need, but there are some basic ones that you definitely know you're going to need. Claims assistance, remediation assistance. And so we would definitely recommend getting standby contracts for nothing. If you have it for nothing else, at least get it for remediation. But in doing this, let's make sure that you're in that procurement compliance, because you may wind up using, it could be a huge disaster, and remediation and physical repair costs run over the limits that you have of commercial insurance. Or it may be a lower level disaster that's just cleanup and emergency services, and you may wind up using that those remediation services to recover your deductible. And if that's the case, we need to make sure that you're in procurement compliance, which that could be putting those things out to bid. If you're in a co-op compliant or co-op friendly state, maybe utilizing those and considering being part of a co-op there. Again, I use Louisiana as an example on the 2-year time period. Louisiana is a state that is not co-op friendly. So you're going to have to look towards more true procurement steps in that state. And rules can be different state by state. So definitely consult with someone like Shelley along the way for that one. But the great part about doing this is you're going to get an established rate schedule. One, you're going to be in compliance with all your procurement rules. But second, you're going to work through all the terms and conditions. You're going to have a rate schedule all set while it's blue skies outside, and you know who's going to help you. So that whenever an event just happens, it's making a phone call, shooting an email, and it's not dealing with legal and procurement and trying to get those vendors set while you've got assets that are damaged and deteriorating after a loss event. So all this right here, it's what the ounce of prevention is worth a pound of cure on this standby stuff. Next, statement of values updated if needed. And so we talked before about the completeness of statement of values. But what a lot of people have seen, especially in the inflationary environment that we're in, is things cost a whole lot more now to replace. And it's becoming more apparent in inflation that maybe someone, again, garbage in, garbage out on the SOVs, has just taken values that may have been book values, or they may have been, assessments that were done, but they're done based on a market value, not maybe necessarily on a replacement cost value. So you wind up with assets that are woefully uninsured for what it actually costs to replace that asset. And we see this a ton, especially going through renewals. Clients that have an average of $125 per square foot on buildings that we know average replacement cost per RS Means or other valuation softwares are upwards of $250 plus. Okay, so they could have partial losses, and I see this with clients all the time. There's a tornado that causes a roof lift and some water intrusion in the building, and we're doing those repairs and replacing the roof and gutting and fixing the interior that was water damaged, and we're approaching the limits of the location just for a roof lift and some interior damage. Had that location actually burned to the ground, or had the tornado completely destroyed it, they would have been underinsured by millions of dollars on those locations. Now, this is a hard conversation to have because premiums are already skyrocketing for everybody. This is the hardest property market that I've seen in 25 years of doing this. And so the last thing people want to do is say, well, I need to increase my statement of values by 40%. And not advising that you necessarily go out to the market and do that, because once you do that, you cannot unring the bell. Those values will be out there. But at least you need to know internally what the values are on your organization. Are you 10%, 20%, 30% under? And find a way to try to remedy that and bring it up to the level that it needs to be. I've got some clients that are saying, Jason, I'm going to increase values 10 or 12% this year. I'm going to try to do it 10 or 12% next year, and that's going to get me where I need to be. But right now they know they're kind of below. Insurers are also being very critical of this. And some of you may have already seen it going through renewals. I've seen insurance carriers that want anywhere between 10% and 18% increase in SOV to cover the inflationary cost of repair materials in the event of a loss event. And brokers trying to fight that down to something more reasonable. So a good way to do this is you can get RS means valuations by building type. Okay. And that's just going to give you a square foot, whether it's a cinder block building or it's a wood frame building. And it's going to give you, based on regions of the country, what average replacement cost is on a per square foot basis. Match that up against your SOV for some sanity and make sure and see where you're at. You may have some locations that are great. You may have some older locations that are on your schedule that really aren't up to snuff from a valuation standpoint. And then that's your focus, and that's going to be your area for remedy going forward. Next is this disaster recovery strategy and plan. You know, do you have your standby agreements? Do you have your policy provisions lined out for the best that you can based on your risk, sublimits, deductible structure, things like that? Do you have your plan kind of lined out? And with these standby contracts and all these vendors that now you've lined up, let's make sure we document that in some sort of online web portal where everybody's going to have access after a loss event. And this is going to be for your business continuity plan, which is essentially a phone tree of points of contacts. If you're getting remediation vendors lined out for your locations, and if you're a large organization and you've got locations all over the country, you may have different standby contracts for different regions. Or if you're all concentrated in one or a few campuses, you may have one vendor. But making sure you know who's that point of contact in facilities for every location on my statement of values. And let's match that up with a point of contact for the remediation firm that I'm going to have on standby. Make sure those people know each other. Make sure they know their phone numbers and emails and can communicate with each other quickly. Because as a hurricane's going to roll in, those remediation vendors are going to start mobilizing assets for those clients that they have standby agreements with. They're going to be checking in with you. They're going to say, hey, we're in the area. We could respond in X number of hours. Let us know if anything happens. We're tracking it on our end. And your facilities guys need to know that as well, too. When that happens, that's going to be a much faster recovery for everybody. So the best way in talking through all this is going through a few war stories. That's kind of how it sticks with people when you see how these programs actually work for people. So the first case study we're going to go through here is actually, this is a commercial enterprise, for-profit industry, but they encountered a huge flood loss after Hurricane Ida. So you would think, oh, flood loss after Hurricane Ida, they must have been in the Gulf Coast. No, they were in Pennsylvania. Because as people remember, as Ida came ashore quickly in New Orleans, it worked its way all the way up the Northeast, dumping tons and tons of rain, causing major flooding in New York, New Jersey, and Pennsylvania. So this organization that thought they were far from any kind of hurricane exposure wound up seeing 4 feet of water in a flagship facility that they had of over 600,000 square feet. And you can see here all the damage that it did, 17 major pieces of equipment, thousands of dyes that they had, but also too, their raw materials, over 400 paper rolls that they use in this converting plant, as well as 165,000 square foot finished goods warehouse that you see in the upper left-hand corner here. Water and paper do not mix well. This was a total disaster for them. And when the adjuster showed up, they thought initial recovery to get this place cleaned up was going to be 2 to 4 months. Okay. But our clients had a plan. They did have standby contracts. They had remediation vendors on site, one for equipment and one for building. However, that one for the building took one look at the scope of the disaster and said, this is too big for us, we're out. And they drove off site. And so they called us in a panic over Labor Day weekend, wanting to see if we can get them some other vendors. Now, we already had an established relationship with them. So yes, even though this wasn't a standby agreement that they had, we got them 3 other options of remediation vendors on the phone, physically there to interview with them in less than 24 hours. They interviewed the very first one, signed them up, and by that evening, they had assets and personnel rolling on site for the recovery. The remediation was completed by this vendor in 5 weeks, and they had partial production resumed in 6 weeks after the loss. Compare this to the 2 to 4 months that the insurance adjuster thought just for the remediation process. So acting fast, having the right vendors in place is key to the speedy recovery here. And as a result, we had that documentation in front of the insurance carrier. We were working through any, scope alignment issues that we needed to talk through, which resulted in them getting 40% of the claim paid in the first 30 days. But better yet, 80% of the claim paid in the first 90 days. So this got them recovered, got physical assets restored so they could resume services, and got them their cash that they needed for their recovery much faster. And this was because they had a plan. Next example here is going to be for an ISD. So this was after Hurricane Harvey. We had a client who had 40 different campuses that sustained flooding in the Houston area. And they quickly needed help in developing scoping of estimates, construction project management, the full gamut of oversight. And also, while they're recovering from this disaster, also setting a plan for mitigation to see how do we prevent this from happening again? Well, again, they had those existing relationships. So between their broker and DRS, we were able to get them everything that they needed to be able to repair their 600,000 square foot high school within 7 months. And this was really key because hurricane season happens in the summer, or Harvey happened in August. So in 7 months, this allowed them to get back into their high school right after spring break so that their seniors could graduate from their own high school and not some temporary campus that they were at. So again, not a for-profit industry, but again, delivering critical services to their students. And this, having a plan, enabled them to provide those services again as quickly as possible, and in this case, critically meeting a graduation deadline for their seniors. So this helped them to receive a successful recovery of over $100 million in their property damage related to the recovery. And they were actually the first applicant because they were in early into the system of receiving category E or permanent repair funding. And then because all along the way, we were helping them also develop that mitigation plan as they're recovering and how do we prevent this from happening again? They were also awarded $25 million on the back end for hazard mitigation to help reinforce this from happening again. So floodgates, things like that, to prevent damage to the assets if a storm like this were to occur again. Another example here is another ISD, Vider ISD, and again, this is after the rains that are coming off of Harvey into Southeast Texas that caused massive flooding and damaged 2 of their schools there. And this is where the school district just needed a plan. They didn't have expansive other campuses to put their students at. So they needed a quick implementation of a temporary solution to be able to get their 1,100 students back to school. And again, because they had those relationships, they were able to turn to their disaster recovery team to get the vendors that they needed in within 10 weeks to get them a temporary school solution that got them back in operation and back to educating students. And so this is the kind of thing that if you wait to plan or react for this after the loss event occurs, you're going to wind up running into roadblocks of resources being taxed, you not having the right people lined up, and it's very hard to get this kind of result if you don't have these resources lined up. So after going through the war stories of all the examples here, you get this plan set up, you get your coverage lined out, then it's the job to monitor this, each and every year. because things are going to change. Right now, it's a super hard property market, but hopefully it won't stay this way forever. The pendulum's got to start swinging the other way. But each year you need to review and see if you've had any additions or deletions to your SOV or locations, if anything has changed from a coverage profile of things that you need to do, and then updating your insurance coverages appropriately. And then also those standby contracts. If you're adding locations to your organization or getting rid of those locations, making sure you're updating those points of contact, making sure you're updating the documentation that you have, and just making this part of your annual review process to go through, all the things that we discussed. And one thing that I didn't mention too, having a plan like this helps to differentiate you with the commercial insurance carriers. So as you're going through this monitor and renewal process each year, having these plans in place helps to differentiate your organization from another one when you're facing 20, 30, 40 or more % increases in your insurance premiums. Being able to tell the insurance carrier, hey, we're different. We have a plan. We're going to recover quickly. And then, especially if you do have loss events, demonstrating this program. I'm seeing insurance carriers now where our clients that have this program, they're building a much stronger relationship. They're wanting to offer competitive renewals and to keep those policyholders because they've demonstrated through their plan that they are different. They are recovering faster. And every insurance carrier wants to partner with a prudent insured that's got a plan and isn't someone that's just going to rely on the purse strings of the insurance carrier. So, this is a great objective to go through and will actually help you into the market. So with that, we are right at about the 48-minute mark here. So I did get through this in 45 minutes and we wanted to leave some time for questions. So I'm going to put this slide back up because what this does is buckets, the P for D that we talked about: review, identify, implement, and monitor, and those bullets of things. So I don't know if any questions have come up along the way that someone might want to address. We can definitely go back into the slides, but I don't know, Corey, have you seen anything pop up in the chat?
Nothing in the chat, but good opportunity to, like I said, open up for people to, you guys to come off mute, ask a question. If you'd rather put it in the chat and me read it off, happy to do so. You can do the raise a hand feature, whatever works for you, but a lot of material covered. I know that the review section is can be pretty meaty. So anyone that's got any questions, please feel free to ask them now.
It's always hard getting the first one started.
And if it's procurement related too, we've got Shelley on here.
Yes.
Yeah, Pamela Teal just asked if we'll be sharing this presentation. The answer is yes. If anybody, I've got the initial sign up list with y'all's emails, but if you guys want to direct message me in the chat your email to make sure we will send that out. But Pamela, I've got your email.
Yeah, Shelley, thank you for being here as backup, because if we get any deeper than the slides I just covered, I don't want to step out of bounds here.
Absolutely, Jason. You did a great job of emphasizing the importance of having a plan for procurement, particularly if you think you're going to have any reliance on FEMA at all. I might just offer one more cautionary tale if while we're helping people get their courage up to ask some questions. One of the things, and when I worked on the public entity side, a lesson learned for our entity was you can't always rely on the peril that you experience, the most significant loss from being what you're used to experiencing. So our location, we were always worried about, we're north of Houston, worried about having enough wind coverage, from the hurricanes, because typically wind damage is what we would have by the time the hurricane reached inland. But the last disaster that we had, it ended up being more of a flood event than a wind event, just because of the nature of the storm. And so our flood insurance only covered 25% of the overall loss. So we were looking at 75% of that total loss having to be shifted to FEMA. And I would say, we worked with over 250 various suppliers and contractors, having to procure all of that according to the federal standards, et cetera. So the more work you can do with your procurement team, particularly you public entities and eligible private nonprofits on the front end, making sure you've done a gap analysis, knowing what's the most restrictive rules that you need to follow, the better off you'll be, because doing that in the midst of it is really a tough job. So if I can offer any advice there, that would be the primary advice.
Thank you, Shelley, and Jason, and I guess attendees too, without getting too salesy, we do offer a service, similar to kind of just this high-level presentation where Jason would sit down with you and your respective teammates, look over the insurance policies, state, SOV, things of that nature, and provide this type of feedback, very low cost. But Jason, kind of question for you, if individuals on this call don't do that, what can they do? Who can they reach out to as well? Is it their broker?
Yeah, I'd say,
internal, like how else can they kind of go about implementing what you just did too, if it's not through DRS?
yeah, I'd say if you took the steps that we just talked about and worked with your broker on this, I think your broker would appreciate the proactiveness of this. I mean, a lot of brokers will try to set up, property strategy discussions, anywhere between 120 to, 150 days out. And so engaging with them to review these things, to work with the updates, to understand your coverages and have them explain that, it's a good opportunity to engage more with your account team and also to get to know your property claims advocate, which is always good to have that established relationship before something occurs.
Thank you. All right, anyone have any additional questions?
Well, if not, Corey, looks like we're going to wrap up at the 1 hour mark. Just like
Yes, we
planned.
will. Well, appreciate everybody's time for joining us. I did grab y'all's emails. Like I said, I'll reference the list of registered attendees we had ahead of this and send out the recording and the slides. Hopefully in the next couple of days, if not early, I guess after the holiday next week, but we'll get that out to you guys very soon. If any questions arise in the interim, let me know, reach out. Happy to be a resource. And thank you, Jason and Shelley, and hope everybody has a good rest of their day.
Yeah, from everybody here at Disaster Recovery Services, thank you very much for spending time with us and attending the webinar. We really appreciate it. All right. Thank y'all.